Welcome to this explainer, where we're diving into what is honestly one of the most fascinating financial mysteries going on right now. We're looking at a company that is essentially the absolute bedrock of early computing, but today, they're standing at a completely unprecedented crossroads. Think about it. How does a foundational giant of computing raise $20 billion only to have the market completely panic? The sheer scale of what Intel is attempting right now has the entire financial world watching closely, and today we're going to break down exactly what's happening behind the scenes.
Okay, let's jump right into this bombshell announcement. Intel increased its stock offering and just raised a staggering $20 billion. After all the dust settled with the underwriters, that generated approximately $19.7 billion in net proceeds. We really need to pause for a second and just contextualize that number because that is an enormous, literally company-altering amount of capital to inject all at once. This isn't just some minor balance sheet adjustment, right? It signals a total paradigm shift in their financial strategy and a massive bet on their own future. But here's where the plot totally thickens. With the stock plunging below the $95 offering price shortly after the announcement, investors are frantically trying to crack the case. The market is completely split right down the middle on this. If you're watching this, you're probably trying to figure out which side of the fence to land on yourself. Are we looking at the ultimate value trap? A historic sinkhole for capital? Or are we actually looking at the ground floor of Intel's next golden era, a brilliant turnaround setup that's offering an incredible opportunity?
To secure all this cash, which, by the way, is strictly earmarked for massive capital expenditures and essential working capital, Intel had to sell over 210 million brand new shares. And honestly, this makes perfect sense when you look at their ambitions. When a company decides to build state-of-the-art semiconductor fabrication plants, those massive multi-billion-dollar facilities we call fabs, there are absolutely no cheap shortcuts. You're building ultra-clean rooms, you're acquiring incredibly precise machinery, and you're scaling operations that literally rival the complexity of space exploration. They need mountains of cash to even attempt pulling this off.
So the really crucial point here is that existing shareholders are now facing roughly 4% dilution. In the stock market, there's just no such thing as free money. By issuing hundreds of millions of new shares, every existing slice of the Intel pie just got a little bit smaller. This 4% dilution is essentially the hefty entry fee the current shareholders are paying for this new strategy, and it places intense pressure on management. It means Intel must turn this fresh capital into immense future value. They have to absolutely prove that $20 billion in the bank today is going to create significantly more than $20 billion in value tomorrow.
Section 1. Growth versus dilution. The financial whiplash.
Now here's where we find an incredible contradiction. Despite the pain of that shareholder dilution, the actual earnings performance is frankly pretty stunning to see from a legacy tech giant. Let's look at the real numbers. Q2 revenue hit an impressive $16.1 billion, with adjusted earnings coming in at 42 cents per share. This is substantially better than the company's recent historical performance. It shows life, it shows movement, and most importantly, it shows serious cash flow actually coming in the door to help fund these massive ambitions.
To put that $16.1 billion into perspective, that represents a 25% year-over-year jump. Let that sink in for a second. Accelerating top-line revenue by 25% for a legacy tech giant of this age is almost unheard of. Intel's management actually described this as marking their strongest top-line growth in more than 15 years. For a massive ship like Intel to turn and accelerate top-line revenue by a quarter in a single year, that represents a huge fundamental shift in momentum.
But the true financial whiplash really comes from this specific number, a massive 59% explosion in year-over-year growth for their data center and AI business. This isn't just some gradual incremental improvement. This is a massive business unit essentially strapping itself to a rocket ship and taking off.
So why is this rapid acceleration happening? It's because that data center and AI revenue accelerated to $6.3 billion on the back of the broader AI infrastructure boom. Now, while NVIDIA might be out there selling the gold, the AI accelerators and GPUs, Intel is positioning itself to sell the massive amounts of heavy machinery required to mine it. The wider AI ecosystem needs robust CPUs, incredibly complex networking, massive memory requirements, advanced packaging, and sprawling servers. Intel is positioned right smack in the middle of that infrastructure build-out. They're fighting a very different battle than NVIDIA for sure, but it's proving to be a highly lucrative one.
Section 2. The Foundry Moonshot.
And that brings us to their absolute biggest gamble, the Foundry model. This is where Intel wants to manufacture chips not just for its own products, but for other companies too, directly rivaling titans like TSMC.
But looking at the numbers, while foundry revenue is up 31% to $5.8 billion, we have to be really careful here. A huge portion of this is internal production. It's basically Intel paying Intel. The breakthrough valuation metric that analysts actually care about isn't just internal revenue. It's whether major external chip designers actually choose Intel for production at scale. Securing those massive, outside contracts from the biggest tech companies in the world is the critical missing piece of the puzzle that investors are desperately waiting for.
Looking at their manufacturing roadmap, we see the incredibly ambitious timeline they've laid out. Right now, in the present, they're proving their 18A process, which just entered high-volume manufacturing, using highly advanced extreme ultraviolet or EUV lithography. That's the incredibly complex laser technology required to print these modern microscopic chips. In the near term, the immense pressure is on to secure high yields, land those external customers we just talked about, and actually prove their profit margins. All of this is building toward a massive transition to the highly anticipated 14A node, targeted for 2028. It is a very long road, and technology milestones do not automatically equal financial profits.
Section 3. Bull versus bear case. Let's weigh the evidence.
Let's actually start by attempting to destroy the bull thesis. The bear case here is incredibly heavy. We're looking at painful dilution from those 210 million new shares, plus there are immense, ongoing capital requirements just to keep the lights on and build these new fabs, and they face fierce, deeply entrenched competition across literally all fronts. TSMC has an absolute stranglehold on manufacturing scale, NVIDIA completely dominates AI accelerators, and AMD is aggressively eating into the traditional CPU and data center market. Finally, there's a really important lesson here regarding valuation. Just because the stock is deeply down from its 52-week high of $142 doesn't automatically mean it's trading at a discount today. The risks are very real and deeply structural.
But what if you flip the argument? The picture completely transforms. If Intel flawlessly executes on the 18A and 14A manufacturing nodes, if those super lucrative external customers actually arrive, and if their data center and AI segment continues this massive growth trajectory, the narrative shifts entirely. Foundry losses will shrink, margins will massively improve, and Intel will reclaim its status as a titan of US advanced manufacturing. When you buy the stock today, you aren't really buying their current stable earnings. You're buying a story, a vision, and a monumental turnaround effort with massive potential upside.
And adding to this potential upside is the strategic U.S. government backing. Semiconductors are no longer just consumer tech that go into our laptops. They are critical, foundational infrastructure. They are tightly connected to national security, defense operations, data centers, and the domestic AI race. This backing gives Intel a safety net and a level of strategic importance that exists completely outside the normal rules of corporate competition. They are deeply vital to a much larger national effort.
Section 4. The final verdict. Let's score the stock. It's time to evaluate all this data and render a definitive score for the stock based on the source analysis. But before we do, let's shut down one assumption right out of the gate for the income investors out there. Intel's dividend is exactly zero. If you're looking for reliable, steady, quarterly income like you'd get from a blue-chip consumer staple, this is absolutely not the place. This is strictly a turnaround play for capital appreciation.
When you put Intel through the source's 5-factor scoring system, the underlying tension becomes crystal clear. Let's really look at how these numbers interact. You've got incredibly strong catalysts scoring a near-perfect 19 out of 20, alongside solid earnings growth at 19 out of 25. But look how heavily that is dragged down by steep valuation concerns, scoring just a 12 out of 20 and a deeply sobering risk score of 8 out of 15. The upside potential is undoubtedly there, flashing brightly, but the execution risk casts a very long, dark shadow over the entire operation.
So, tallying all the evidence from our factors gives us a final score of 75 out of 100. It's a solid passing grade for sure, but one that comes with a very heavy asterisk attached to it.
So what's the ultimate takeaway here? Well, for conservative investors who demand proven execution and stability, this remains a firm watch. You really need more concrete evidence that the foundry strategy is actually working. But for those comfortable with significant volatility, the source rates at a buy/watch due to the massive potential upside of their AI infrastructure and manufacturing progress. Just remember, this isn't in the same safety category as the massive cash-rich tech monopolies. It's a high-stakes turnaround bet.
Which brings us to the ultimate question. I'll leave you with this final, provocative thought. Can they actually do it? If Intel fails to execute on their complex foundry roadmap and AI expansion, this will go down as one of the most expensive, painful capital raises in modern financial history.
But if they succeed in harnessing this $20 billion, it could very well be the greatest corporate turnaround of the decade. Thanks for joining me on this explainer, and keep your eyes closely trained on those manufacturing milestones.